Just last week, Walgreens stock announced that after a 90-year stretch, they are cutting their dividend. In this video, we're going to walk you through why is Walgreens cutting this dividend? What's it mean for the business? What's it mean for the shareholders? My thoughts on Walgreens stock going forward. If you enjoy educational investment content, you're watching Unrivaled Investing. I do appreciate you hitting that thumbs up, hit that subscribe button. So looking at Walgreens stock, clearly this has been a threat. Clearly the stock has been under pressure for the last decade. You can see for the past 10 years, the stock has lost nearly 90% of its value, a similar picture for the last 20 years. And so this does suggest that shareholders knew there was a problem developing over time. You oftentimes don't see, a stock making new highs and then, a cut. There's oftentimes signals from the price action that in this case, it's very clear over a multi-year perspective. Clearly, the issue was getting worse. And this wasn't just a valuation contraction. This isn't just Walgreens stock getting a lower multiple over time. This is actually the fundamentals getting much worse. And you can see just over the last 2-3 years, their U.S. retail pharmacy operations, which is the bulk of their profitability. This is a chart that shows operating profitability by segment. The U.S. retail, they're international because they did this Boots Alliance acquisition, and they have various U.S. healthcare assets. You could see that the U.S. retail pharmacy, the thousands of Walgreens, on nearly every corner store, in the U.S., this is historically very profitable for them. And that's dropped by more than 50% in just the last 2-3 years, from over $5 billion to a little over $2 billion. And so while international is roughly flat, and you can see the U.S. healthcare assets are, still around, a slight loss, so this is the main driver of why, Walgreens stock has gotten hammered, but there's some other elements too. So why, what did management talk about with the cut? They talked about, yes, they are suspending their quarterly dividend. So the dividend that they paid out this past year, you're not going to see that. And they talk about a few things. One is a change in capital allocation, i.e. how did they spend their money? How did they spend their free cash flow? Aimed at strengthening the balance sheet. So that means they're going to take some of their cash flows, pay down debt, reducing debt over time, and improving free cash flow. That alone, it's funny to hear management say, hey, we're going to cut the dividend to improve free cash flow. That it's mislabeled. It's not the right way to say it. Your free cash flow is what is used for acquisitions. It's used for dividends. It's used for buybacks. So for them to say, hey, we're cutting the dividend to improve free cash flow, that's nonsense. The reason why you're cutting your dividend is because your free cash flow wasn't good enough to sustain it. And now you're realizing, hey, we should have had more prudent policies in the past. So it is important to sort of see through management's gobbledygook in this case. So saying, hey, we're using it to improve free cash flow, that's not really the case. I mean, reducing the debt will lower their interest expense, which could improve free cash flow, but it's really reducing the debt and these other elements, which is talking about achieving, this retail pharmacy turnaround. So that's what they're focusing on. But they also say, this is a very important clue. They say the company's cash needs over the next several years, including, so the reason why they cut is because they might need the cash with respect to litigation and debt refinancing. We'll talk about these two elements in just a second because I think they're super important. So this is not just about, hey, we need to improve operations. That I'd argue is that the improving operations leads to you need to cut the dividend if you haven't improved your operation. So it's important to understand, which came first here. So the real reason, if you parse through, management's, messaging over here, it's really, we have too much debt and there's some litigation. And hopefully we can turn operations around so that way you see a lot of free cash flow in the future. So let's talk about, some of these, data points that management's, vaguely talking about. When we look at their debt, we can see that they have a sizable amount of debt due. They have over $8 billion in debt, of which they have over $3 billion due in 2026. So next year. And by the way, last year they were cash burning. So that's a very problematic position to be in. Generally, if you have a lot of debt and you have, some of those mature in a short time period, you have a few options. One of which is you can say, hey, I'm generating lots of free cash flow. Maybe I repay it. But if you're not in that situation, it's usually some sort of kick the can approach where you go, okay, well, maybe I can find someone that will then lend to me and refinance that debt. Well, if your operations have been stinking lately and your profitability is declining, that means that cost of the debt is likely going to go up. So then your interest expense start going higher, and it's sort of this vicious cycle downwards, because then the lenders see, oh my goodness, your profitability is declining, and then they charge even worse interest rates. So you can see this sort of spiraling cycle that Walgreens faces. They do have a debt facility that they could, in theory, refinance this with, but that is a lot of money, $3 billion due within 2026 that they're going to need to come up with. And they don't have that on their balance sheet. So you're going to need to see the cash flow from operations either sell some assets or, get lucky with some lenders saying, hey, there's no problem borrowing $3 billion from me, even if you've been cash burning recently. But that's only half the problem. The other half, as management talked about, is the litigation, where just earlier this month, the Justice Department filed a nationwide lawsuit alleging that Walgreens knowingly filed millions or filled millions of prescriptions that lacked a legitimate medical purpose. So that is a concern. Unclear what the dollar impact could be from such a lawsuit, from such violations. And this follows several other settlements. So where Walgreens has already agreed to pay hundreds of millions of dollars for fraudulent healthcare billing. This was in New Mexico, Texas, and Florida. That was in September of 2024. But they also agreed to pay another $100 million for generic drug pricing and mispricing from a lawsuit. That was November of last year. So I would say there's clearly not just one roach in the kitchen here. There's a lot of, troubling signs here, arguably mismanagement. And then to take a step back, thinking about Walgreens, their margins might be a more systematic problem, as you have these pharmacy benefit managers that negotiate drug prices on behalf of the insurers, and that they sometimes even own. So sometimes you have pharmacy benefit managers also owned by the same parent company that also owns an insurer, think CVS. And you have someone like Walgreens negotiating with a pharmacy benefits manager that effectively says, hey, here's the price for these different drugs, for these various different prescriptions. And that has resulted in significant prescription reimbursement pressure. So it's unclear if there's even a possibility of a significant turnaround, given sort of how convoluted this system is with dealing with PBMs. So this might be a bigger issue beyond the litigation, beyond the debt. So what are my thoughts on Walgreens stock from here? Clearly, there's a lot of challenges. First of all, as always, this is not financial advice. Also, just last week, Zeus M, a premium member of the Unrivaled Investing community, shared the following. This is a direct quote. I think not only you deliver great value, but also you created a great community. This follows Henrik, another premium member, saying subscribing to your platform is the best financial decision I've made in my life. If you're looking for compelling ideas, come check out Unrivaled Investing. And so when I think about the quality of Walgreens, it's not surprising to see it get somewhat low scores. You've got a sizable amount of debt. You've got the uncertainty of the maturities. You've got their recent, significant cash burn, their losses, the declining trajectory in terms of the share price. Not surprising, the track record. It's not surprising to see it getting very low quality scores if you try to have an sort of unbiased assessment. However, where they do shine and where it does sort of stand out is alignment. And this is from Stefano Pessina, who's the executive chair of Walgreens, where he owns around 17% of the company. And he was previously running Boots, which was acquired by Walgreens. And so this is, it's interesting to see, someone that owns 17% of the company, doesn't take a salary, involved. And that does increase the odds of a successful turnaround, in my opinion, because you have the alignment. You have the incentive to say, hey, I've lost a lot of money here. This could be worth a lot more. How do we right the ship? And how do I, judge management accordingly? Now, he's in his 80s, so it's possible, it doesn't work out. But it is worthwhile to understand that point. So first, from an alignment perspective, that's what I like to see. The next is from a valuation perspective. I think it's very obvious that the valuation here could be quite compelling. I mean, management is guiding to, even after all the challenges that they face, as they look at right-sizing their real estate, as they look at, thieves stealing from their retail operations, having a lock-up shampoo behind, glass cases, all sorts of nonsense that society has to deal with. I think that's just because we haven't had really a strong leadership element for the last few years, where it's like, okay, why not tolerate, vandalism and petty thievery? I mean, it's just bananas. There was a comment. Charlie Munger used to say something like, it's amazing how much goodwill would be created with a few public hangings, something along those lines. And so, thinking about Walgreens, think about the valuation. Look, despite all the challenges, they're still saying, $1.40 to $1.80 in earnings this year. And keep in mind, this is a sub $10 stock. So you're talking about 6 times forward earnings. It's easy to see hundreds of percentage upside potential if they execute, and if they don't get, sort of clobbered by the litigation, by further, let's say, roaches getting discovered, by the debt turning into a problem. It would be easy to see a situation where this could be worth a lot more, just from valuation expansion. Now, thinking about the checklist, and this is the checklist I use on, all the companies that I call out. Occasionally I'll buy something that doesn't fit this checklist, that's more of a special situation. So I look at this. I think you have the aligned management, because, 117% shareholder, he's going to be calling the shots. If management's not delivering, which I'd argue they aren't. The compelling valuation, yeah, you're talking about a single-digit earnings multiple. And by the way, their profitability used to be much greater. So you could see a scenario of much, much sort of higher if things work out. But these other elements is where I start struggling, like the obvious growth potential. That's just something I just don't see it. When you're reducing your share count, facing these challenges, I don't view this as an obvious growth potential. And the blow-up risks, I'd argue, are significant, such as the Department of Justice getting involved. So it's possible that they right the ship, but those last 2 ones, where it's just not an obvious story where I'm saying, hey, here's the reason why this business could be multiples bigger in the future from a fundamentals perspective. It's not just, hey, we're stabilizing the ship and therefore the multiple goes from 6 to 15 times, which could happen, or that, hey, maybe margins, revert back to where they previously were. I don't have a strong conviction on why you should get that growth. And, the blow up risks regarding litigation and debt, it's a little too much for me to stomach. So you have tremendous upside potential, but you also have, I'd argue, some of the lower quality elements that is creating this opportunity for the folks that are willing to sort of stomach it. If it indeed does turn around, we will see. It's not something that's right for me in my own personal journey. I want, at the end of the day, I want something that checks out, this whole list where it's, I feel a lot more comfortable about, 1 through 5. And the reality is most companies don't get all 5. So it's important to, figure out what's right for you in your own investment journey. If this video talked about Walgreens, their recent dividend cut, has been helpful for you, I do appreciate you hitting that thumbs up, hit that subscribe button. Thanks so much for watching Unrivaled Investing.